Hey everyone, welcome back. Today we're diving into a major financial event, the Federal Reserve's 0.5% interest rate cut. You've probably heard the news, but what does this mean for your investments? I've had some people ask me, for the everyday investor, what does this mean? I want to tackle that topic today and what that means for your future financial plans. In this video, I'm going to break down the key impacts this decision has on stocks, bonds, real estate, and more. Whether you're a seasoned investor or just getting started, this is the kind of move that could create new opportunities or present new risks. So let's get into it. First of all, I want to advise this is not me telling you financial advice. This is for educational purposes only. The information I'm providing is not telling you to go buy or sell certain items. This is simply to educate you on what the Fed rate cut means and how it can impact investors. The biggest thing I want to point out to start out is that you, as a long-term investor, you should be looking at buying and holding for long term. The bottom line is this should not impact you because you are buying and holding based on your plan. But there are some small intricacies we need to look at. Let's start with number one, the impact on stocks. The first thing is a short-term boost. A rate cut can often lead to a rally in stock markets as borrowing becomes cheaper for businesses, encouraging growth and high earnings. We actually saw that. The day the Fed made the cut, stocks dropped a little bit, but the next day they skyrocketed. Well, today they've come back down a little bit. It's not a science that it's always going to explode or it's always going to come down, but long term, it encourages borrowing. It encourages people to increase their business. And so this can create an income boost in the stock market. But be cautious for long term. While the stock market may initially respond positively, there are risks that the rate cut signals economic weakness. So think about it. Interest rates have been going up. Why did they do that? Because there was too much money, too much spending in the economy. The supply and demand was out of whack. We had COVID, we had the stimulus money, all this money coming into the economy, and then we had production going down because businesses were shut down and things were happening. So you had increased money flow, decrease in production, and then all of a sudden things opened up and people had all this money that they were given and all this money that they hadn't been spending because of lockdowns, and the production had decreased. People start flooding the market with spending, and that drives the demand. Prices had to try to keep up to balance that. Because if there's more money than there is supply, the demand outperforms and it drives prices up. And that's what we saw happening, particularly in certain segments. So that's the whole reason it was being driven up and inflation went up. And its purpose was to cool down the spending to allow production to catch up. As that has begun to happen, we've seen inflation come back down. It is now back down around 3%. It has done its job by increasing interest rates. Inflation has come back down. And so that's a good thing. It's done that because people are spending less, which is a slowing of the economy. So we don't know. Nobody knows. Don't listen to anybody that says, I know what's going to happen. They're predicting what happens. And you have people that predict constantly. So they're saying we're going to have a recession. We're going to be in a bull market. We're going to be in a bear market, blah, blah. All these things they predict. And then every once in a while they get one right. And they say, see, I told you. Well, guess what? If I sit here and I constantly say, we're going to have a recession, eventually I'm going to be right because the cycle of the market continually creates recessions. It's the ebb and flow, the balancing. As money increases, as spending increases, as money decreases, as spending decreases, all these cycles, eventually there'll be another recession. Eventually we'll have inflation come back down and then we'll have it go back up. That is part of the cycle in our economy. Be cautious, but don't let it hinder your long-term plans. You're not buying today to sell tomorrow. So what the market does on a day-to-day basis isn't that important. Check out the video I did here on why one-day market swings should not affect you. You are here for the long term. Dave Ramsey's famous for saying the only person that gets hurt on a roller coaster is the person who jumps off. And that's his analogy of the stock market. The stock market's not like the first part of the roller coaster where it just goes up, 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 up. The stock market is up and down. It feels like a roller coaster, but eventually, long term, it goes. You have to be able to ride the wave, the impact of the downs and the lows, and not jump off. That's typically when people get panicked and sell. Don't let this Fed rate drop impact you in the sense of it changes your psychology of your long-term investment plan. How's it going to affect the bond market? Some people love bonds, some people don't. I'm not here to say buy them or don't buy them, but the bond market will definitely probably see lower yields following a rate cut, which can push investors to seek more risky assets like stocks because bonds are safer and the interest rates go up, bond rates go up. Interest rates come down, bonds are going down. For some, they can consider investing in bonds, particularly long-term bonds that decrease in rates could drive up bond prices, leading to gains. I'm not going to do a whole video here on the bond market and how that works. Just know that if you have bonds, the rate could go down based on these rate cuts. Now let's look at real estate. Real estate's a tricky one. Loans are going to be cheaper. Businesses can buy new properties for their business, expand. They can get loans cheaper. Homeowners can buy and get cheaper loans. Had a lot of people over the last year or so saying, I can't afford a home. The interest rates are 6%. And guess what? Be glad you weren't buying a house back in the late 80s when interest rates hit 13, 14% on homes. Interest rates have gone up. The reason? They're trying to drive the prices down because home prices took off because there was a lack of supply. The demand was higher than the supply, and it drove home prices high. So as interest rates are going up, it's getting fewer buyers, so home prices are starting to settle. But as interest rates begin to drop, people are going to say, oh, I'm going to go buy now, and it's going to drive the demand up. So we could see, I'm not saying it's going to happen, but we could see another boost in home prices being driven up as the demand with lower interest increases. So something to keep an eye on. This could be an opportunity for real estate investors to buy a property and then see the price drive up because of the demand. Again, do your own due diligence before doing anything in investing. Number 4, let's look at the impact on savings accounts and fixed income investments. Things like CDs or high yield savings accounts. Right now, you can get high yield savings for like 5.5%. But as those interest rates come down, guess what? The banks are going to start offering less interest. That's why back in the late 80s, early 90s, you could go put your money in a savings account or a CD and get 10, 11%. Well, back through the 2000s, 2010s, banks were paying savings accounts like 0.02% if you were lucky. CDs were 1%. It was ridiculous. So as interest rates are low, so are savings and fixed rate returns are going to be low. So people are going to be looking, what do I do with my emergency fund? What do I do with this money that I need to keep available? You're going to need to look for other ways to invest that are still making good interest, but keeps your money liquid and is not at risk. Low risk, emergency funds, things you're saving for, down payment for a home. Those types of things should not be invested because that's not a long-term gain. That is a short-term, I need it. And when I need it to not have lost value because of a big dip in the market. So we need to make sure we're looking at fixed income investments and where we can put our nest eggs that we need for emergencies and those such things. And inflation concerns, a significant rate cut could lead to inflationary pressures again, because it could start driving the demand back up as people start borrowing, people start spending more. It could create another burst in inflation. It may not. We have to look and watch that. And that's what the Fed will be doing to see if it holds before they do the next rate cut. We could probably see a couple more rate cuts they expect by the end of the year. But if this starts seeing the prices of things going up again because the demand goes up, they may hold off on that. So we will wait and see. It probably won't happen, but we don't know. Again, nobody knows. Even the Fed doesn't know. They're making their best guess off the data that they have, and they're analyzing it, and they will make changes as they need. So those are some things I want to talk to you about. The last thing I want you to think about as far as the rate cut is you should continue to diversify. Continue to diversify is key. With changing interest rates, maintaining a diversified portfolio becomes even more critical to manage risk. And stay informed. Monitoring how the economy reacts to the rate cut over time will help you adjust your strategies accordingly. I want to throw this out. The reason inflation has come down is because demand has come down. Now, interest rates will come down to increase. Its purpose is to try to get people buying again, borrowing again. I want to encourage you. A lot of people are excited. Oh, interest rates will be down. Don't let it impact you from your plan. And by going into debt, just because you can get a cheaper loan doesn't mean you need the loan. I understand you may need a loan for a house. That's fine. Cheaper interest rate, better. I know you may need to finance your car, but just because you need to finance your car doesn't mean you should go buy more of a car because the interest rate's lower. At 6%, 7%, oh, I can get a $30,000 car because I can afford X number of dollars a month. Well, now the interest rate, if it drops down and it continues to drop and we can get it back down to 2, 3%, guess what? Doesn't mean you should go buy a $50,000 or $60,000 vehicle because the payment will be the same. You should be glad, like, okay, this is the vehicle I need. It meets my needs. And guess what? Now I'm paying a lot less. That should be your mentality. Don't let the interest rate entice you to borrow money or to see that your credit card interest is lower. So now I can start charging things again. No, no, no. Stay out of debt. Use this as an opportunity to reduce your expenses and to increase your investments. So the decision to cut the rate by a half a point is significant. It is bound to affect everyone's investment strategy, but the key takeaway is this: stay informed and always consider the broader economic picture when making moves. That's it for today on Simply Money. Hit that like and subscribe button. Help me reach 200,000 subscribers and leave me a comment. What are you concerned about? What questions do you have about the rate cut? And we will answer those for you the best we can. And I'll see you next time on Simply Money.